Hello and welcome to the Warrior Insights channel, where today's topic of discussion is the credit crunch of a $1.7 trillion loss, impacts to small businesses and investors. Before I begin, I'd like to remind you that you may follow along with my Substack article, which can be found at athenaangelique.substack.com. So what does it mean when banks get into trouble? It means fewer loans, such as commercial real estate, fewer credit cards, and fewer auto loans. It should concern every American when headlines read, "The banking crisis gets worse. $1.7 trillion in unrealized losses loom as U.S. banks rapidly bleed deposits." What does that mean? Well, during the week of March 15, 2023, $98.4 billion was pulled out of U.S. banks, and the following week, an additional $126 billion from U.S. banks. The small and medium-sized banks suffer the most by having such large deposit outflows. And when they have large deposit outflows, they lose too many customers and forfeit critical funding and may have to sell assets at a loss to cover those withdrawals. Sure, they may offer a few interest points on your savings account, or maybe even offer a great money market rate, but when they're forced to sell at a loss, they might not be able to stay open. Silicon Valley Bank's customers withdrew $42 billion in one day, leaving a negative cash balance of $958 million. Bloomberg called the Silicon Valley Bank withdrawal the largest bank run in more than a decade. When depositors pull their money out with such high demand, it forces the banks to sell assets, often at an unrealized loss, in order to provide liquidity for its customers. But this is the problem with being over-levered on long-term securities and anticipating interest rate decreases. In addition, loans lose value when interest rates increase, and the losses from interest rate increases may be comparable to the total equity in the entire banking system, thereby rendering it insolvent. Initially estimated by the FDIC, U.S. banks have $620 billion of unrealized losses on their balance sheets. But a study conducted in mid-March found the actual losses to securities holdings were around $780 billion. Although the largest banks may be strong enough to withstand these paper losses on their financial sheets, they may be teetering on the brink of disaster for years to come. As I mentioned in a Substack article last week, Jamie Dimon was warning that we haven't seen the worst and the effects of what has happened in March. And again, in a statement in an annual letter, Jamie Dimon said, "Bank failures have provoked lots of jitters in the market and will clearly cause some tightening of financial conditions as banks and other lenders become more conservative." There are systemic issues that go beyond individual banks, just as there were in 2008. It wasn't really about Lehman, Bear Stearns, or AIG, but how the failure of the system, the tide of money going out, revealing problems in the institutional framework. The burdens of this will not likely fall on depositors, but the shareholders. As banks act on the lessons of 2008, they build up their cash and collateral liquidity. They minimize the risk to portfolios and hedge everything they have left on the asset side of their balance sheets. Banks stop performing necessary functions in the financial system or the real economy that the markets need in order to work. They get greedy. They hold on to everything that they have. Here we see in this chart provided by Bloomberg that U.S. bank lending dropped dramatically. During the last 2 weeks of March, commercial bank lending fell by a record of $104.7 billion, with more than $45 billion stemming from a drop in loans issued by small banks. This is the worst since 1973. And the pullback in total lending in the last half of March included real estate, commercial, and industrial loan segments. We already seen problems and cracks in the commercial businesses by not renewing their leases of large office space, and more than half of the $2.9 trillion in commercial mortgages will be up for refinancing over the next several years. Commercial mortgage rates anticipated to be 3.5% to 4.5% higher than existing mortgages. Morgan Stanley analysts predicted commercial property prices could fall as much as 40%. They say it rivals the decline of 2008, but in 2008 we didn't see the work from home movement that we did this time. Less demand for office space means less demand for the surrounding businesses such as coffee shops, restaurants, bars, and even car ride services. During the March FOMC meeting, we finally see discussions of that word recession. In the last line of the statement here I included in my Substack, we see recessions related to financial market problems tend to be more severe and persistent than average recessions. So finally, they're mentioning the word. Some of the FOMC members view the decline as a good sign, believing the interest rate increases are finally fighting inflation. The chief of the St. Louis Fed doesn't think tighter credit conditions stemming from the recent banking turmoil will be substantial enough to tip the U.S. economy into recession. But if you've been following my videos and reading my Substacks, you will know that the market and all the charts and curves are indicating otherwise. The FOMC officials expect rates to reach 5.1% by the end of the year, meaning they might have one more interest rate hike they can eke out before pausing or pivoting. They might be able to hold on. Then we see this chart that was issued April 3rd. It is the ABA Credit Conditions Index, which says that demands for loans may continue to be strong, but the supply of credit is drying up fast. So the American Bankers Association Economic Advisory Committee stated the following, or released the following analysis. They looked at the headline credit index, the consumer credit index, and the business credit index. So the headline index fell to 5.8, decreasing 6.7 points. It's the lowest point since the onset of 2020, and we're seeing weakened credit conditions over the next 6 months. But now we talk about UNI, the consumer credit. It fell 7.9 points to 5.8 in quarter two. And this says that consumer credit conditions are likely to weaken over the next 6 months. And anything below 50 indicates that. But 5.8 is far, far lower than 50. So we got a long way to go. The business credit index, again, it also fell 5.6 points to 5.8 in the second quarter. But in the business credit index market, it'll show that credit conditions for business will continue to weaken over the next 2 quarters. So in the consumer credit index, it indicates weakening over the next 6 months, whereas the business index, it's weakened over the next 2 quarters. The following chart shows the standards for commercial and industrial loans to small firms. The tightening standards we can see is starting to creep back up there. So the credit crunch is taking its toll already, according to a Zero Hedge article. And if you read the last line, it says, the most since December 2012. Worse, the 4-point monthly drop in the series was the biggest collapse in credit availability in more than 20 years. This is for small business loans. Americans intuitively know things are bad. A Gallup poll conducted on April 3rd indicated that 83% of Americans view economic conditions as poor or only fair. And even the guru of all investment gurus, Warren Buffett, is sounding the alarm on the banking system. In a CNBC appearance on April 12th, he stated, "But I did sell banks that we owned for 25 or 30 years. I just don't think the system's quite right in terms of connecting punishments to culprits." Then he basically said that Americans weren't even talking about banking system or banking system failures until SVB or Signature, but it is definitely on everybody's mind. And when Buffett is making comments and performing actions that lead us to believe the banking system is a failure, and this guy obviously has inside information and is very well connected, I think we should pay attention. But remember, when big banks go bust, the CEOs and the upper management, well, they don't get fired. Nothing happens to them. Heck, the bank could be charged with felonies, but they're still in power and they could still walk away with a nice golden parachute if they want. But who suffers? Well, the stockholder. And if they bail out the banks again, you and I, the American taxpayer. But what does this mean for you? Well, if you need a business loan or personal loan, I suggest you go get one soon, as a window for lending is slowly closing. Now is the time to do it if you could stomach the interest rates, get the credit now, and have a greater potential for refinancing at a lower interest rate later. Because if you miss the window and interest rates do drop, the banks may not be even willing to look at you. Or you could sit and hold, invest in stores of value such as gold and silver. And if you want to take a little bit more risk with the market, you can invest in short-term T-bills. Build up your dry powder so that you can make investments when the economy is in recession mode. The more reserves you have, the more appealing you'll look to even tight lenders. Then lastly, look into syndication or partnerships. Examine investment opportunities as a group instead of an individual. Taking part in a syndication means bigger deals and better deals. Means you have access to tighter credit markets and you won't have to sit on the sidelines. And you'll also get a return. But make sure you do your due diligence and research and make sure you know who you're investing with and what they're investing in and what the guidelines are. But as we could see in this segment of lending, even the lending market is telling you that recession is coming. So I hope in my channel that I've given you things to think about and action steps to prepare for what is coming. And that is my goal, to make sure that you can stay informed and stay vigilant so that you don't get blindsided. I want you to be strong and I want you to fight out there for what's coming and to make yourself better and your families better and more secure. So until next time, thank you for watching. Ever forward.